the non-performing loans figures have basically not moved. We have not yet seen a materialization of credit risk in the bank's balance sheets. We have seen an increase in provisions. The banks think that basically they have done their dues, and I must say that also in the market analyst community there is a perception that sufficient adjustment in the cost of risk has been made. We are of the view that probably more adjustments will be needed, and especially that banks need to be extremely careful, attentive in looking into the unlikeliness to pay of the customers, even through moratoria, which are now creating some issues for banks in terms of concretely appreciating the credit risk of their customers.
Let us also focus on your comments on the changes in modeling of credit risk inside the bank. So how much is that a concern to you, that banks are just changing the way they're actually calculating credit risk, by that lowering the official credit risk they are telling us, but the picture is actually different?
Well, indeed, let's say one of the evidence we presented today is that the banks have changed the sensitivity of their indicators of the probability of default of counterparts to a recession, to a significant decrease in the GDP. And this could indeed show an attempt to reduce the impact of the crisis in their portfolios. At the same time, we've also to admit that these crises of a peculiar nature. There is an unprecedented amount of policy support measures, of fiscal support measures, government guarantees on loans. So these, to some extent, can justify the adjustment in the parameters. But this is something that we are, trying to investigate further with the banks, and will be a key focus of our supervisory efforts in the weeks and months to come.
Sir, I want to just ask about the European recovery. One of the key factors that will determine the strength of the European recovery is how quickly we can get vaccines out to the people. And this week, the EU's vaccine efforts have been thrust firmly into the spotlight. Are you concerned that the EU's slow vaccine rollout relative to other parts of the advanced world could jeopardize the recovery in the region?
Well, that's not up to me to say. I would say that in general, the estimates of the recovery have been now quite robust. So in different moments, the ECB central projections have remained quite stable, even in face of the second wave of the pandemic. And we are still, let's say, envisaging a rebound to pre-crisis level around mid-2022. So that's our central projection. For the moment being, this is what we are working with, and we think that in general the recovery will come underway. But our key focus as supervisors is to understand how much casualties there will be before the recovery takes strength, and how much this will materialize in terms of deterioration of asset quality in the bank's balance sheets.
Sir, there's a line to me that stood out in your report regarding the business model of the banks. And you specifically say that a lower net interest income has hit the business model. How much responsibility does the ECB take for that happening, especially with a very low negative interest rate environment that hasn't been conducive at all to bank profitability?
Well, to be honest, the main driver in the declining profitability of European banks in 2020 has been provisions, so the increased credit risk. That has been the main driver, understandably, because, of course, that's what you would expect in a situation in which you have one of the harshest recessions on record for the European economy. In terms of the interest rate environment, of course, low or even negative interest rates have an impact on the interest rate margins, but there has been a positive effect on the lending volume. So, and also a positive effect on the trading book valuations. And more generally, I would say that the very accommodative monetary policy from our colleagues on the central banking side has been extremely important to avoid an even harsher recession and an even harsher impact on the potential deterioration of credit quality of banks. So I wouldn't say that the interest rate environment is a main driver in the profitability, although of course it has a depressive effect on the interest rate margins.
Let me ask you about your dividend policy recommendation, because it's widely seen as more restrictive than the one in the US and also in the UK. So have you taken that into account when you came up with your recommendation, and how is it going so far?
Well, we received a positive reaction from the banks. Well, positive in the sense, not the sense that they were particularly pleased with our recommendation, but they intend to comply with our recommendation, which is the most important thing. I remain convinced. I know that we have been fairly conservative in our recommendation, and I remain convinced that this is the right stance in a moment of remaining uncertainty and in a moment in which the ability of the banks and of the supervisors to have reliable projections on the capital path for the banks ahead is still very challenging. We expect these to improve in the coming weeks and months. And as we announced in December, if there are no material significant deterioration in the external conditions, we expect to repeal our recommendation in September and to move back to the old policy of vetting the dividend payments of banks on the basis of their soundness and their capital positions in a normal old-style way.